Have you ever noticed how life gets more expensive overnight? Gasoline, groceries, heating bills. As if someone quietly turned an invisible lever and everything shifted. That lever exists, and right now it is in the hands of soldiers thousands of miles away. February 28, 2026, the United States and Israel launched strikes on Iran. Within 48 hours, Brent crude oil jumps 13% in a single trading session. 1 week later, up 30%. Within 10 days, Brent breaks $119 per barrel. The Strait of Hormuz, the narrow waterway carrying 1 in every 5 barrels of oil traded on Earth, is effectively shut down. This is not just a war. This is a planetary-scale energy shock. You might be wondering, why should this affect me? I'm not a trader. I don't own oil wells. But here is the truth. Every war in the Middle East since 1973 has sent shockwaves through the global economy within weeks. Higher oil prices mean higher prices for everything, because oil is inside almost every product you buy. It is in the plastic of your phone, the fuel of the truck that delivered your food, the heating in your home. Oil is the invisible ingredient in modern civilization. In this video, we will walk through exactly what is happening, step by step. First, the historical parallels. What past wars taught us about oil prices? Second, the current situation, real numbers right now. Third, the chain reaction, how oil prices trigger inflation, interest rates, and stock market moves. Fourth, expert forecasts for 2025 and 2026. And finally, what you, as an investor or as a regular person, should actually do. History has a pattern. Every major conflict in the Middle East has ended with an energy shock. Not sometimes, every time. Let's look at 3 key moments. Quickly, because the lesson is simple, geography is destiny when it comes to oil. The countries sitting on the world's largest proven reserves, Saudi Arabia, Iran, Iraq, Kuwait, UAE, together hold over 60% of Earth's known oil. When those countries go to war, the whole world pays. 1973, the Yom Kippur War. Arab nations embargo oil exports to the West. Result: oil prices quadrupled in 12 months, plus 400%. American drivers waited in lines for hours just to fill their tanks. The U.S. and European economies fell into recession. 1990, Iraq invades Kuwait. The Gulf War begins. Oil jumps 120% in just 4 months. Another global recession followed. 2003, the invasion of Iraq. Oil rose 80% over the following year, sparking a decade-long commodity supercycle that lasted until 2008. Each time, a war. Each time, an oil shock. Each time, the global economy paid the price.
Now, 2026. The current crisis has already been called the largest disruption to global oil trade in history by the International Energy Agency. Not since 1973 has the world faced such a sudden and severe supply shock. The difference this time? The world economy is larger, more interconnected, more fragile. A shock that took 6 months to ripple through in 1973, today moves through financial markets in 6 minutes. We live in a world where an airstrike at 3 a.m. can move your mortgage rate by afternoon. So, history is clear. Conflict in the Middle East means energy shock, always. But understanding the past is only useful if it helps us understand the present. So let's look at exactly what is happening right now, in numbers.
Let's go straight to the numbers. No speculation, just facts. Brent crude oil, up approximately 45% since the conflict began on February 28th, pushing past $119 per barrel. European natural gas, Dutch TTF benchmark, up 70% in 4 weeks. Diesel and jet fuel across Asia, prices have more than doubled. The Strait of Hormuz, tanker traffic has fallen from 20 million barrels per day to near zero. That means over 11 million barrels per day of production in the region is effectively stranded. The IEA has activated its largest ever emergency reserve release, but analysts say it can only cover days, not weeks.
Now, who is hit hardest? 80% of the oil that used to flow through the Strait of Hormuz was bound for Asia. China was receiving over 5 million barrels per day from the region. That is 37% of the entire region's exports. India, 14%. Japan and South Korea, 12% each. Europe depends less on Middle Eastern oil, but heavily on Qatari liquefied natural gas. Europe's gas storage at the start of March stood at only 46 billion cubic meters, half of what it held 2 years ago. These are not abstract statistics. These are the foundations of entire economies, shaking. What about bypasses? Can the world route around the Strait of Hormuz? Only Saudi Arabia and the UAE have pipelines that bypass the strait. Combined capacity? Roughly 5.5 million barrels per day. But the gap created by the blockade is over 11 million barrels per day. So even if every bypass pipeline runs at maximum capacity, the world is still short more than 5 million barrels every single day. To put that in perspective, 5 million barrels per day is roughly equal to the entire oil production of Canada. Gone. Just like that.
Now we know the size of the problem, but how does this translate into your daily life, into inflation, interest rates, and the value of your investments? Let's trace the chain reaction, step by step. Link 1. Oil to inflation. When oil gets expensive, transportation gets expensive. When transportation gets expensive, everything in a truck gets expensive, which is almost everything you buy. But there's a second hit, less obvious but just as powerful. Expensive natural gas means expensive fertilizer. Urea prices, the key nitrogen fertilizer, have jumped roughly 30% in 1 month. That will hit food prices, not immediately, but by autumn when this season's crops come in. We are looking at a two-wave inflation, one from energy, one from food. And central banks around the world are watching both waves approach, knowing they cannot stop either of them with higher interest rates. Link 2. Inflation to central banks and interest rates. The U.S. Federal Reserve was already holding back on rate cuts. Inflation was sitting above their 2% target before the war started. Now, rate cuts are off the table for the foreseeable future. The European Central Bank faces an even harder dilemma. Inflation is rising, but the European economy is weakening. They cannot raise rates to fight inflation without crushing growth. Japan's central bank,
Lock central banks on
India's
pause.
Reserve Bank, South Korea's Bank of Korea, all are pausing or
Locked
reversing
central banks
rate
on pause.
plans.
Locked central banks
Nomura
on
Bank
pause.
stated directly, this conflict has locked central banks on pause for the majority of 2026.
Locked central banks on
Higher
pause.
rates
Locked
for
central
longer
banks
means one
on
thing
pause.
for you. Borrowing stays expensive. Mortgages, business loans, car
Locked
loans,
central
all
banks
of it.
on pause.
Link 3. Interest rates to financial markets. When rates stay high, stocks suffer. The era of cheap money that powered markets for a decade is over, for now. The S&P 500 fell approximately 4.5% between March 3rd and March 20th, from 6,816 down to around 6,506 points. The Dow Jones continues to lose ground. But not everything is falling. Oil company stocks,
ExxonMobil, Chevron, Halliburton, BP are...
So the chain reaction is clear. Oil shock, inflation in everything, central banks frozen, equities under pressure, volatility everywhere. This is the financial architecture of a wartime economy, and it affects every person on Earth who uses money.
The situation is serious, but markets and economies have survived oil shocks before. The question is, how long does this last, and how bad does it get? For that, we turn to what the world's leading energy analysts are projecting. Let's be honest. No analyst can tell you exactly where oil will be in 6 months. Anyone who claims certainty in this situation is not being truthful. What the best institutions in the world do, the IEA, the EIA, the IMF, Goldman Sachs, is build scenarios. 3 of them. A base case, where things gradually improve, a moderate case, where the conflict drags on, and a severe case, where things get significantly worse. Let's walk through all 3.
Base case: a ceasefire or diplomatic resolution within 4 to 8 weeks. Under this scenario, the EIA projects Brent above $95 per barrel through April and May, then declining to around $80 in the third quarter at approaching $70 by the end of 2026. The EIA's 2027 average forecast, $64 per barrel. Inflation globally would run about 0.8 percentage points above pre-war projections. The Federal Reserve and ECB would take a pause, no cuts, no hikes. Under this scenario, no global recession. Painful but manageable.
Moderate case. The conflict continues for 3 to 6 months. The Strait of Hormuz remains partially disrupted. WTI crude potentially reaches $100 per barrel. Brent follows. Global inflation rises 1 to 2 percentage points above forecasts. Rate cuts push to 2027 for most central banks. Some countries enter recession, particularly energy-importing emerging markets.
And now, the severe case. The scenario no one wants to think about, but which analysts are required to model. If the conflict expands, drawing in more regional powers, or if critical infrastructure in Saudi Arabia or the UAE is struck, analysts project Brent above $150 per barrel, European gas above 60 euros per megawatt hour, or potentially much higher. Under this scenario, global recession, a food crisis driven by fertilizer shortages, stagflation, simultaneously high inflation and high unemployment in multiple major economies, financial market instability, sovereign debt stress in import-dependent nations. This is the tail risk. It is not the base case, but it is real, and it is why the IEA calls this the largest threat to global oil trade in history. First, and most important, do not panic, and do not make large moves based on headlines. Volatility is extreme right now. Oil moved $5 per barrel on a single tweet. Stocks swung 2% in a session on ceasefire rumors. This is not a market to time. For investors, here is where the opportunity and the risk live. Energy sector stocks and ETFs, XLE, VDE, the major oil companies have a short-term tailwind from high prices. But be aware, high prices incentivize more production, especially in the United States. EIA projects U.S. output growing to 13.6 million barrels per day this year. Long-term, that pushes prices back down. Gold remains a powerful safe haven. It holds value during inflationary uncertainty. Consider it as portfolio insurance, not speculation. Inflation-protected bonds,
TIPS in the U.S., similar instruments in your local market, become attractive when inflation is expected to run above normal for extended periods. That is exactly the current environment. Second, watch the central banks. The first signal that the Federal Reserve, or ECB, is moving toward rate cuts is a green light for growth stocks, technology, healthcare, consumer discretionary. That signal has not come yet, but when it does, and it will eventually, that is the moment to start increasing exposure to growth assets. Third, do not ignore currency dynamics. In crisis periods, the U.S. dollar typically strengthens because investors globally flee to the world's reserve currency. A stronger dollar creates challenges for emerging market economies that hold dollar-denominated debt. If you hold assets in emerging markets, watch your currency exposure carefully. For consumers, not investors, here is what to expect and prepare for. Expect higher energy bills for the next 2 to 4 months at minimum. Expect food prices to rise through the autumn. The fertilizer effect works on a delay. If you have a variable rate mortgage, do not expect relief before 2027. Consider fixing your rate if that option is available to you. And here is the perspective that history gives us. The 1973 oil shock lasted 18 months. Then markets recovered. The 1991 Gulf War shock lasted less than 6 months. Then recovery. The 2003 Iraq shock resolved in under a year. Every one of those crises felt permanent when it was happening. None of them were. This one will not be either.
If this video gave you clarity, please subscribe. We are tracking this situation daily, and we will release an update as soon as the picture changes. Leave your questions in the comments. We read every single one. Stay informed, stay diversified, and take care of yourselves.